Hey, everybody, this is Sherry Ferguson with the Portland Chamber of Commerce, and you are here joining us for the Portland Chamber Connection. So, we are putting these together. I'm going to let some people get on to inform you about ways that we started out with mainly COVID. So, we wanted to talk about how COVID is affecting all of our businesses and all of the things, what steps people are taking and changing. So now we're continuing to do that, but we also want to add to that, how can you prepare during these times to better yourself and to get to another place that you're ready to go? So first of all, let me make a comment. Don't forget to comment to win 2 meals from Milo's Cafe. We'll be drawing tomorrow. So make sure you make comments so that we can get you in for the drawing. And we have with us today Joanie Neal from Acopia Home Loans. Great to have you today, Joanie.
Glad to be here.
Well, I know that this is something that you do all the time, but of course now you've had to change your direction and how you operate a little bit. So I know that getting information out to the community is one of the great things that you like to do. You like to educate people. So let's start talking a little bit with the COVID. One of the things that they have talked about and people don't understand unless you've ever had to go through it is the forbearance. So explain a little bit about what that is and how people during this time of unemployment could take that and use that to their benefit.
Absolutely. So the forbearance is the ability to negotiate a temporary forgiveness of your mortgage payment and agree upon a repayment, whether it be 3 months, 12 months, or up to a year with your lender. The way that this came about was as part of the CARES Act. There's not an infrastructure in place, nor would there have had time for them to do something like that to really determine who needed it, who didn't. So they opened it up basically for anybody to call and say, hey, I can't make my mortgage payment. And, we'll talk about the goods and the bads. The good is that it's good. It gives you some relief. There's been some talks about, at the end of that 3 months or 6 months, the full balance is due. Well, that's not really going to help anybody, is it? So I don't see that, that's going to actually come to fruition. But again, there wasn't enough time to put an infrastructure for this plan for the mortgage forgiveness program. So it's available for those that need it. At the end of that time, there are a few other terms, so to speak. Modification is one of them. We don't like to use the word loan mod because that's kind of usually a step right before foreclosure activity starts. So it's not going to be a modification, but the truth is that in 3 months, if I can't make my payment month 1, 2, and 3, how am I going to make 3 in total month 4? So that's not realistic, but we haven't gotten far enough along to know really what those options are going to be. From a professional, having done this for so long, including back when the housing market kind of did a little tumble back in 7, 8, 9, and 10, the lenders will work. They don't want to see the house into foreclosure. That's the last thing they want. So just keep in mind that if you need it, it's there. Don't be scared to use it, but we know also too, that there's been a report that 70% of the people that have used it don't have to. And that breaks my heart a little bit because that's not doing anybody any favors. I thought the number when I read the report from the Mortgage Bankers Association was a little high. So, who am I to know how they come up with that data? But that was a published report. But it is there for people that need it. And if you need it, absolutely, you should take it.
Well, and typically in a forbearance, so do they typically require all of those back payments at once, or do they put those on the end, or do you pay interest and not the loan? How does that work, or does it vary based on the lender?
It does vary a little bit, and it also varies on the loan type and the agency, so to speak. So you have conventional loans, which are Fannie and Freddie backed loans, and then you have FHA, which is a Ginnie Mae, and then you have your state bond program. So all of them are going to come out, and I see this happening sooner than later on how they're going to do that. There's no late payments or no late fees. They are still collecting interest. But what's happening currently is the servicers, whoever services that loan, is physically making the payment for those borrowers. And a lot of people don't know that, but they are. So when you're reading that there's tightening in the credit part of the mortgage business as you're trying to get pre-qualified now, where we may have been able to take a 580 score before COVID. We've now had to look at a 640 score on government, 620 on conventional. And the reason for that is the liquidity. They just can't afford to make all these mortgage payments on behalf of the borrowers that are doing the forbearance and then still not be a little bit protective of what money they have in the lending. So, the answer to that is we don't know yet exactly how they're going to handle that at the end of this. We do know, though, that it's there available. And what I would presume that would happen is they would put that on the end, Sherry. To do that means to re-amortize the loan. So people really have to understand that your mortgage is set with an amortization schedule. When you closed, you signed a schedule for a 30-year mortgage. So how do you change that recorded document? So that, I think, is the challenge, is that, typically when we put things on the end, it's a loan. We don't want to do a loan modification. That's kind of a step up or foreclosure. So I know they're going to come up with ways of doing that. I suspect they're going to take what's owed if you miss 3 payments, and they're going to divide it out by 30 or 3 years or so, and then add it to your current payment. Something similar to an escrow shortage.
Okay.
Something like that, where the taxes go up, you don't have enough in your escrow account. They give you the option to pay it in one lump sum or space it out. That's what I think is going to happen at the end of the day.
Well, that's great to know, because I did not know in a forbearance that your local lender is actually paying that money. So
Absolutely.
you really have to think about what they have on the line for all of this as well. So that is great information to have there. So
Right.
So, and I mean, forbearance, I'm sure, is not for everybody. So, you want to be careful and make sure that you only do it if you have to.
Yeah. What I think they did is they came out with it really quickly as a way to help Americans, and they should have, because unfortunately the COVID has affected many of us out there, and having that without having penalty is, you feed your family, you pay your mortgage. I mean, you're going to feed your family, keep your electricity on, or pay your mortgage. So it's good that they have the option. Without an infrastructure, you have to trust that people need it, are the ones that are taking it. I think that some of them may have taken it and not realized, oh, wow, I'm going to have to pay this in 3 months. This isn't like a free skip a payment,
Yeah.
So I think education on that's important, because it's not a freebie. It really hurts everybody if you take advantage of that forbearance, and you don't need it. It hurts you, and it hurts everybody. So.
And I think that is good to know as well, because sometimes when people think that, oh, I don't have to make a payment, well, again, somebody's got to pay something at some point. It's not, free money. So thanks for letting us know about that. So,
Absolutely.
So do you want to talk a little bit about the current market and what are rates? If I was looking for a house, I know they vary based on your credit score and all of that, but what are we looking at? I mean,
that's the fun part that I want to talk about. So we'll start with rates. Rates are crazy. I have done this for almost 25 years. I've been blessed with having a lot of that time being in, range from 4% to 6%, still great rates. But then you drop down to 3s and even in the 2s, and it's like, wow. And we want to keep that trend, because that makes a difference on if you're buying a $180,000 house at a 4.5%. Versus you can now do a $200,000 house with the same payment due to the difference in rates. Your rates are going to fall on a 30-year anywhere from 2.75 to 4.25. I mean, rates are based off the loan program, which conventional, FHA, USDA. I'll talk about THDA in a second, because that's a grant program that I really want to make sure you guys know about. So it's based off the loan program that you're using. The credit score, which we now know is some of these programs are a lot more credit score driven on the rate. So the higher the rate, the better, or the higher the score, the better the rate. But that's what they're running on a 30-year. And we get rate sheets 2, sometimes 3 times a day. I have borrowers, especially ones that are refinancing, that I might pull a 643. One of the great things that I can do is I can take a credit score that's, especially if it's a conventional loan, I can look at the credit and I can say, okay, if I do this, this, and this, as borrower, I can rescore them and get them to a 720. And that's what I'll do. And those of you that have been with me, that have closed with me before, have probably had me do that with you, because there's not a dog in the fight with us with rate. We want you to get the best rate. So we will suggest, do this, do that, and get your credit score to this number, and it can get you 3/8 better point. So you definitely, if you're looking to refinance, you want to start there, or start there, and do an application so we can see where you're at on your credit score. That's the best advice I can give anybody, is to do that.
And sometimes these things, I've told my children, credit is not something that is fixed automatically. You can't just all of a sudden wake up one day and I have a lot of credit. So I try to explain to my kids as they're growing up and they have no credit. It's not that you have bad credit, but you have no credit. So as you're growing, you're going through, you got to prove yourself that you're going to make those payments and you're going to do those things. But if you don't owe on anything, it's hard to do this. So it's kind of a catch-22. And building takes a little bit of time, but there's also little things that you can do, as you're talking about, to do that based on what issues you see when you're looking at those.
Yeah, because, I hear this a lot. Well, my Credit Karma says this. I use Credit Karma. I think Credit Karma is a great way to monitor any new inquiries, anything like that. But it's a self-pull. It's not going to be accurate. Here lately, mine's been higher than Credit Karma, so that's good. The programs are going to tell us what lines of credit is needed and how long. The credit that's a little bit more advanced, more sophisticated, is going to be for your conventional loans. Usually those are your second buyers. They're selling and buying, and that's when credit score is even more important. But when you go over to the government side and you're looking at USDA, FHA, and THDA, which are the three most popular ones for a first-time home buyer, their score on, let's just say THDA and USDA. USDA is 100% financing. So all of Sumner County is included with the exception of Hendersonville and the city of Gallatin. That particular score is with the THDA grant is 640. So if you've got a 640 score, you get 100% financing. And then on top of that, you get a 5% grant. And that 5% grant can be used towards paying closing costs. Their program sets the rates though. So the rate on that is 4%. That's just, they don't change it, but maybe every 3-4 months. And then you have something like FHA that is a 2.875 or a 2.75. And it's going to require at least 2 things that you've had for a 12-month period. So like your children, if they're establishing credit, you want it to be at least a 12-month period, unless they're using some non-traditional credit, which would be rent, utilities, things that's not an installment debt, but they pay cell phone, car insurance. So there's a lot of different ways. There's so many different ways that you can look at credit when you're trying to do an approval. But at the end of the day, they need to see some form of history. And revolving credit, I'm not big on getting a lot of credit cards, but if you really want to get a credit score high and get it high quick, credit card.
Just don't leave it like big balance. That's where you'll get in trouble.
Yeah.
But well, one thing that I also want you to touch on is you talk about 100% financing with USDA, but there also comes some additional cost when you do that. What happens with insurance, your mortgage insurance, and yes, how does that affect, and does it come off? Do you eventually get away from that, or are you stuck with that for the rest of your life?
Yeah, great question. So PMI comes into play when you don't put 20% down. Back in the day, they didn't have FHA loans. They had a savings and loan. If you remember the movie, It's a Wonderful Life.
Yes.
They worked at a savings and loan, and people used their land as collateral. And then in the 50s, they came up with a way to have home ownership for folks that didn't have the 20% down, with a catch. And that catch was, we're going to give this money with nothing down. We're going to give you this mortgage with no money down or very little money down, but we need some form of insurance to protect us in case you default. That's where the PMI kind of came into play. FHA has the highest. USDA has the lowest. So let's just say $100,000 loan. FHA's mortgage insurance is 0.85. So that's $85 a month they're going to add to the payment. USDA has their mortgage insurance set at 0.35. So that's $35. So another reason why USDA is probably one of my favorites. there's not really any difference in the loan cost, but the mortgage insurance being a cost is really the only difference between the govies. The rates on the FHAs are usually lower than conventional. PMI can drop off after 9 years of having having major payments for, in a period of time. A lot of people don't wait that long. They refinance it into a conventional, or they, sell it and move up. But there is the option to get rid of your PMI at some point, depending on which loan program that you're using.
Okay. I know that's always great information to know, because I know that you don't have to put your 20% down, but it's always good to put some money down to avoid things like that, if there's any way possible. But
there's a conventional loan that is called Home Ready and Home Possible, and those are 3% down programs. And those loans are a little bit easier to get off without having to refinance, because it's a conventional.
Okay.
Conventional loan, yeah.
Okay. Well, I think sometimes people get into things and they don't realize that their cost and what they're paying. So sometimes when they think, oh, well, my payment should be this, and then they find it's more because of whether it's PMI or even your insurance and things cause your premium to be higher. So
yeah.
So what about refinancing? Do you have a lot of people doing that now? Because with the rates as low as they are, I remember when I got a loan, my rate at 7% interest, I thought I was doing good. I thought that was really good. It has been several years ago, it was, but still.
Yeah. I did too. I remember we had the option, and we bought our first house in 95, and we had an option of 7% or with a point, which is paying 1% of whatever your loan amount is. It was 7.25% with no, and then 7 with a point. Rates, yes, the refinances are, we can't even keep up. There's so many. And interestingly enough, because I think we all are doing things differently with the COVID, staying at home, and then just getting back to just being together as a family unit, maybe getting a pool, maybe adding a sunroom. We've had a lot of cash outs, refinances for people that are wanting to upgrade their property while they can get these lower rates, or change their term from a 30 to a 15. It's really been helpful for folks to accomplish those types of things.
So when people are wanting to, they've built up some equity, either because they've owned it for a long time, or just because the market's in great shape, and it's becoming, your home is worth more than it was when you purchased it. So in doing that, you're able to do, like you say, either get a pool, because heck, I'm going to have to stay home. I'm going to get me a pool so I can enjoy myself staying home.
Yeah.
So I do think that, and the home improvements, people always like to redo their kitchen, and after so many years. So I think those are great ways to do that. So should they refinance and put it all in that, or should they refinance, but then maybe get a home equity loan and do that, so they're not financing that over the whole time? Or does that matter? What do you see in that?
Well, the home equity is not a fixed payment. So it depends on how much cash. If they're just doing, 10 or less, and, they can do a home equity line of credit, and then they have that, because it's really meant to be a short-term loan. It's not a fixed rate. It's a variable rate. So it doesn't change. That part scares me a little bit, that it's not fixed. If they're doing a major project, most of the time it's in a little bit better interest for them to go ahead and just refinance and take that cash out. From a payment standpoint, their payment based. Yeah. If they're doing bigger projects, I'm seeing them do, a 30 or 15 versus a home equity that's going to put them in a position where they really don't know what the payment's going to be in 5 years. We don't know what the rates will be then, or prime, or anything like that. We don't even know if that's going to be in a year. So
tomorrow, even.
Yeah, tomorrow even.
Well, any other advice, or what other things should we be looking at as to take advantage of the market today? And where should what things should we be doing?
Yeah, I mean, I would, I deal with a lot of first-time home buyers. So I think there's two parts to that answer, Sherry. If you're looking to buy, know that you want to deal with, somebody that you trust, somebody local. That doesn't have to be me. I hope it's me, but if it's not, build a rapport. Don't be scared to have your credit ran. There is a lot of misinformation about having your credit ran. It does not hit your credit score. If it's a mortgage quote, if it's subcoded that way, you have 45 days, in fact, to have that done. So don't let somebody pull in your credit, because again, we want to buy a house, but we really don't know where to start. And my husband has been working on our credit, and he says he doesn't want his credit checked. That's the best way to start, though, because it gives me all the information that I need. Again, it allows me to run the rescore to see if you're at a 613 and all you got to do is pay your Capital One down $500. You want to know that, right?
Right.
So it's all about education and knowing what's available and not being scared to pick up the phone and call to see what those options are. So on the purchases, first-time home buyers, we've mentioned the programs available for 100% financing or 3% down. Knowing the ins and outs of those programs is important. And then from the refinance, I tell this a lot. I'm a straight shooter. I don't know any other way to be. But one of the first things I ask people is, how long are you going to be in the house? There are costs associated. So there's two things to always know when you're refinancing. If you've been in your mortgage for 5 years already and your rate's at, let's just say 4.375, and you're thinking about refinancing because you're seeing everything all over the internet and you can get a 1% rate. Well, that ain't true. But let's just say that you could drop a whole point down to 3.375, but it's going to cost you $3,200 to do it. You take what you're saving and then you figure out where your break even is. And that's going to tell you whether it's worth it to do. And if you think you're going to sell before that break even, it might not be the best thing to do because you're starting right back over with paying so much of that payment towards interest. And once you've been in your mortgage for a while, it starts to convert over to where so much of it's going towards principal and not just interest. But when you refinance, you're starting over. So on refinances, I really take the time to figure out how long the client wants to be there, what their end result is. And then we talk about, like, one of the biggest things I've been doing a lot of lately is they do have equity. And let's just say they've got $30,000 worth of other debt. They take the equity out, pay all their debt off, frees up $1,000 a month, and then they start making extra payments, $500-600. You talk about paying off a mortgage fast. They just don't, it doesn't even occur to them until somebody kind of says, look, you can do this, you can do that, and get rid of your debt and just double up and get this thing knocked out.
Well, and even going to a 15-year, if you're going to be saving that much money a month, you could go to a 15-year and actually really improve that as well. So say I don't own a home and I want to go buy a home. So my first step is not to go start looking at a house. My first step is to find out how much I can afford before.
Absolutely.
Who wants to go out here and look at a $200,000 house and then find out I can't afford a $200,000 house? So I think, so in doing that, what does it require for me to get pre-approved? I think is where you go with that.
Right.
And there's no cost to be pre-approved.
No.
And how long does that take?
I mean, right now, we usually get it done the same day. I've got 3 other, loan officers, so usually somebody's available to do it if I'm not. But it consists of either coming to the office if you're not comfortable doing anything on the internet. I've got 2 locations, Portland and then Gallatin. You'll do, let's say that you do the mobile app. There's a mobile app that's really cool. It's on the App Store, the Play Store, Acopia Go. You go on that and you're going to just do a basic name, birth date, Social Security, some preliminary stuff, where you work, what you make an hour or salary. When you get done, it gets sent to us and then we will start to work on it. Once we start working on it and pull the initial credit, we contact the borrower and say, this is kind of where we're at. And we double check a few of those things. Like for some folks, they put their income in after taxes. We don't use that. We use it before taxes. So we look at all self-employed borrowers. We look at their Schedule C profit and loss to determine what their income is. Get a lot of that. Well, I got a 1099 and made $70,000, but they wrote off 50 of it. So 20,000 is all we got left to play with. So we take it in steps. and we definitely want to give them all their options. They may call us and say, I already know that this is the loan type that I want because my brother got this type of loan. Right. But maybe that's not the best loan. So we make sure that they have all their options. That's important. And it's not very, it doesn't take a long time to do all that. And then we put together the pre-approval letter, partner them with a realtor if they don't have one, and off they go. And they do it with, we also underwrite from the front end. So I think that's really powerful to know that we underwrite our files on the front, because we're not just guessing. If we are guessing, we're going to go back and say, you know what, we really need to get a verification of employment to really do this the right way, so that we're not sending you out with a false positive. So.
Right.
And the approval's good for 90 days.
So I also know that a lot of times I hear of people saying, well, I got somebody that can give me a better rate. So what do you think about shopping rates? Because I know that that's something that some people do, but I'm very leery of just going out to find just anybody to do a loan and giving them my information and this online stuff of people where you don't have that personal connection. So does shopping rates help, and how, what do you advise on that?
I definitely think people should shop for rates, but I think that it's a relationship business like anything else. And I think that having somebody that you can go sit down in front of versus online, that you're never going to hold anybody accountable. You don't really have that relationship one-on-one. So definitely stick with somebody that's local, that you have that relationship, that you can go face-to-face. Most of all the rates you're going to see about 1/8 to 1/4% difference. Okay. They did that for a reason. When TRID came out, which is a law that kind of came into play right after the housing market started to kind of come back to life in 2010 and 11, they came out with certain protective laws, the regulators did, to protect consumers. One of them was the ability to shop around. They encourage you to shop around, and that's why they don't ding your credit report if it's a mortgage subcode. But the other thing that they did is they got rid of what's called overage. And overage is what you make on the back end of an interest rate. If you could, back in the day, you could charge higher interest rates. You could, if the par pricing was 5, you could charge 6. It's awful that it was done back then, but it was. In addition to that, you could charge origination fees and, processing and application. Yes, there's a cost to do business. Every lender is going to have some form of fees, whether it be an application or an underwriting or processing, but they really wanted it to be an even playing field. That's why you saw a lot of brokers go under back then. So you've got about 1/8 to 1/4% that should variance between lender to lender, bank to bank, and then you should have about a $500 closing cost or lender fees between lender to lender. That way you're shopping for service. We really should be shopping for the service.
Right. That's great to know. I do know that I have heard of people not needing an appraisal on their house if they refinance. So you want to talk a little bit about that?
Yes. So when we underwrite it, and you'll hear me say that a lot, because all of these different loan programs have an underwriting method that they use. If the file is strong enough, and I'm not saying necessarily the highest credit score, but there is some internal methods to determine value. And if it's pretty blatant that the borrower has the value there and it can go through the automated valuation, it just comes back with an appraisal waiver where it's not needed.
That to me, and that saves you money. That's what people need to understand, because you're not having to pay for that appraisal. So, so that's an additional savings of, I don't know what the typical cost is now. It's been a while since I've had to do one, but yeah, that's always a great savings. It makes you feel good sometimes when you can say, oh, I just saved some money.
That's right. Yeah. The appraisals run anywhere from $350 to $495, depending on what loan program.
Yeah. So, but no, so any other good information we need to get out there or let people know, or anything you want to share?
I mean, the only other thing that I would probably tell people that, we did have a slowdown in purchase, but I did see something that came out today, actually, from the Mortgage Bankers Association. And that was that the applications, and they track all of this, they're able to track all this, but it has risen 6%. So we're back on we only really saw, I'm going to put this down because I know all this. We are 1.5 off from where we were this time last year. Okay. So our purchase applications were fell 1.5% during the COVID. We are very lucky in Nashville and surrounding Tennessee. I've got family that live in Chattanooga. They're having a huge growth as well. We're just very fortunate to live in an area that's very desirable. We haven't slowed down a lick, but I will say again that buying a home is personal. It has to be the timing that has to be right for you. And when that time comes, though, that's when you really need to do your diligence and get pre-qualified. These rates are low. I can't say they're going to go up anytime this year, but who am I? I don't know. But the market is really strong. We really haven't seen a whole lot of inventories there. Inventory is coming back. New construction is there. But we know the sales prices are going to continue to go up too, just because we live in a gray area. So if you're thinking about it, not sure, you can always call me. There's my number. You can always call me. And we don't have to, I'm not always the first one to say, let's pull your credit and find out. I mean, that's the best way for me to tell you. And it's definitely the only way I can give you an actual pre-approval. But the market is hot. Nothing is slowing things down for us. And we live in a great city here in Portland. And Sherry, I just want you to know how much you do. We all know how much you do. We love seeing you out and your smiling face and everything that you do for the community. It's a great place to live. Really is.
Portland, and it's the people. It is, you can take a city anywhere, but it is the people that are here that make it what it is. And the businesses that, just like you, that support so much that goes on here. Again, we're still a small town. Even as we grow, I hope we can continue to hold on to that small town feel, because that is what makes us who we are.
Yeah.
So, but, well, I do know that, as we're thinking, I can tell you from my experience, if you're looking for a house and say you're pre-approved for $250,000, don't go look for a $250,000 house, because you need to start looking for a $225,000, because you're probably going to find a $250,000 house. But if you start looking there, you're going to want that $275,000 house.
Yeah.
So a little hint is start on the lower side and then work, because you're going to end up buying the high
and
end.
Deal with a great and deal with a great real estate agent. Deal with somebody that has got your best interest and not just that paycheck. And I'm gonna call it like I see it kind of person. Some are fantabulous. Everybody in this office is part of that group, and we're fortunate to have a lot of good ones. And then some are, not. So,
well, some are just,
you trust it's not going to push you to buy more than what you want, is what I'm saying.
Right. And I also think that sometimes you get realtors that are their real estate is a realtor is one that is doing it because they love people and they want to help people, just like you. We do the things we do because we want to help people. And there are so many great realtors in Portland, and I know that that you guys can connect them with the right people, and it's a relationship business as well. Just like the loan portion of it, so is the realtor. So find that realtor that that you trust, and you can turn around and say, hey, I know what they're telling me is right, and they're going to look out for you and watch out for you, and you'll be able to find them here. I know you're there in the office with Exit Realty. And so they have lots of great people there as well as several other realtors in Portland as too. But I know that makes it convenient, you being in the same office there, and
they've got a lot of fun. I haven't got to see them a whole lot because I opened another office as well in Gallatin, so it's nice to be up here and get to see them here this week a little bit more. But
and y'all got a mural outside, look, that's coming together too. I am loving it. So that is
all Derek. Derek is genius. I'm sorry. He has just have so much respect for that man, Derek. If you're watching, I love you. But yeah, it looks so much better out there, and there's some places to sit. We want people to come and boot up. If you need to get on your internet and check your messages or whatever, get you something to eat over at the food truck. Come over here and hang out with us.
Well, the farmers market's going on right now. Maybe a little rainy out there, but the farmers market, so everybody can go out there and get their vegetables and strawberries. Hopefully, I'm hoping I can get over there and get me some strawberries. So we'll see.
If not, let me know, and I'll get Chris to get you some from Crafton.
Oh, there you go. There you go. So Crafton, I love them too. So Well,
Yeah.
Johnny, we do appreciate you and you being here in our community and being a part of the chamber. So, big shout out to you and helping us here in the community, teaching everybody what they need to do to help themselves.
My pleasure, Sherry. My pleasure.
All right, we'll talk to you soon.
Okay. Bye, everybody.